Thank you very much, Simon. So this is so I'm David Thesmar. I will be chairing this session. I'm a professor over there at the Sloan School of Management in Finance, and the topic of the panel is going to be finance, technology, and competition. So the idea is to say, how does technology affect, the financial sector, and how in turn it affects the financial sector, can promote or reduce competition amongst firms. Like, does it promote the entry of new firms, etc. So that's kind of the topic. And to address this topic, we have a great panel, three panelists. So on your right, Thomas Philippon is a professor of finance at NYU. He's had responsibilities. He's been an advisor to the French Minister of Finance some time ago, and he was involved in policy, and he's consulted on by various monetary authorities around the world. And also, what's interesting for us is that he's been he's written a book a few years ago about competition in the US, showing that essentially there's less and less competition among US firms over the past decades, and so that's a useful perspective for us today. Antoinette Schoar, next to Thomas, is a colleague of mine at MIT Sloan in the finance department. She has been at MIT since the early 2000s, since yesterday almost. And she's the managing editor of the Journal of Finance, which is the flagship journal of the profession. And so she has a unique perspective on the flow of new ideas about this topic between technology, competition, and finance. And then, Randy Kroszner has, been at the Council of Economic Advisors, has been a governor of the Federal Reserve, is consulted on various, financial topics nowadays, and so, also a perfect panelist for this panel. Okay, so so we'll have 45 minutes, like for the other sessions, where I'm gonna ask a few questions to the panelists, and let me start with the first question. So let's start with sort of the basic question. So the recent technology has promoted the emergence of very large financial intermediaries, banks, but also asset managers, because it's so much based on IT, on the collection of data, on the training of models, etc. And so together, for instance, Vanguard and BlackRock together manage $20 trillion of assets in the world. And so, is this concentration a good thing or not is the first question. So there are like two sub-questions. First, is this concentration a good thing or not from the viewpoint of consumers of financial services? So do consumers get something from technology in spite of this concentration or not? Or is concentration hurting them? And then the second question, which we might get to, is also, is it the case? So do these financial behemoths that have emerged and that control, a very large chunk of stock markets, how do they affect firms themselves? Because they own a sizable fraction of firm shareholding, and therefore, they have a lot of power. Is it good? Is it bad? So let's start with these two questions. I don't know who wants to start. Maybe Thomas, I think you would be a good person to start with this. Okay, so concentration of asset managers.
Yep, thank you. So I think when you think about concentration in the financial sector, there are a couple of things to keep in mind. The first one, and specifically for asset manager, is useful to keep in mind a story like a tale of two fixed costs, because there are two types of fixed costs, and they really matter for whether we like the outcome or we don't. There is a fixed cost, which is the cost of setting up either a firm or a new product. Okay, that's the kind of fixed cost that limit the number of players. Okay, if it's very costly to set up something like Vanguard, you will not have 10 Vanguards in the market at the end of the day. And then there is a fixed cost per relationship, per client. Okay, which is how much does it cost for to just create an account for somebody. Okay. Now, in models of economics, when we study the welfare consequences, inequality and stuff like that, it's the second one that matters the most, because if you think about people who are unbanked, people who are too poor to access, it's always that fixed cost, that relationship fixed cost. Okay? If you don't have that much money to invest, it's not worth for me to pay the cost of setting up a relationship with you. Okay? And therefore, you end up with nothing. Either you're not banked, or in the case of asset manager, you don't have an account where you can save efficiently. Okay? Now, what fintech does, AI part of it, but fintech in general, broadly speaking, is it kind of increases the first fixed cost and decreases the second one. Okay? So why? Well, because once you have the platform set up, the cost per relationship is much lower. Okay? Before you needed to have like a human advisor, and the human advisor say can only have like 10 clients per day or something. That number was sort of fixed, and that means that the cost of creating a relationship was expensive. Okay? So that's why some people were priced out of the services because of that. Now with AI, that cost goes down. Okay? So that means that the cost of creating a relationship is smaller, so more people are going to have access to these services. Okay? So that's the benefit of it. And, by the way, if you think also about it in equilibrium, it's also a direct subsidy from rich people to poor people, because obviously the reason any big money manager would set up a product is because they want that product to be bought by big portfolio, big accounts, right? They don't really care about the smaller ones. So what that means is that the profit they're going to get from the big accounts are going to pay for the cost of setting up the product. Okay? But once you've set up the product, if the marginal cost of the new relationship is small, you're still going to offer to everybody. Okay? So that actually is a pretty good outcome. Now, the problem is, of course, that to do that, you need to set up, say, your algorithm, your service, your robo-advisor, and that's a big fixed cost either at the level of the product or at the level of the firm. So we are going to have relatively fewer firms because of that. Okay? So that's why these two forces compete. You're going to have either access to a bunch of product for people, even people with relatively low wealth, but on the other hand, the number of independent players creating this product might be more limited. So what we see at the end of the day, whether it's good or bad, is the kind of game between these two things. My own view on that is that as long as we maintain, it's always going to be somewhat oligopolistic, that industry, but as long as we maintain something like, I don't know, 3, 4, 5 big players, we're fine. We don't want to get down to 1 or 2, obviously, but I don't think we don't need 20 to make the market competitive, and so that would be my both prediction and recommendation.
I would agree with this, and I would argue or add to this that if you think about especially retail finance, is a game of lowering cost. Right? Most of what makes retail finance accessible to poorer people and to households is to bring down the fixed cost per relationship. It's really much less about the kind of fancifulness of how you set up your adverse selection or moral hazard within, say, a credit card relationship. Of course, you want to make sure that you don't have adverse selection, but you can resolve it only if you have very cost-effective tools to resolve it. And the more you can actually automate these type of interaction, the better for everyone, because it brings the cost down, right? Because if you think about for small accounts, the overhead that you can charge on a small loan or on a small portfolio relationship with a financial advisor, right? If you cannot bring down the cost, down, everything else after that is lost. You cannot somehow do anything fancy with a poorer person to somehow generate more fees out of nowhere, right? If the person, say, has only $10,000, kind of in savings. And so I think all the technological advances that we have seen have been extremely good for financial inclusion on net. Now, I think the one thing I want to add to this, though, is that while I completely agree with Thomas that we need maybe not 20 players, but 5 might be okay. If you look at what has happened, though, is in the end, financial institutions are the ultimate, applications of economies of scale and scope and network externalities, right? Because trust and liquidity are the ultimate network externalities. So if you don't regulate that market in a smart way, it might lead to more and more and more concentration. At that point, however, we might come down to something where we might not be so comfortable anymore. And the reason why I'm saying this is that if you look at what has happened recently in crypto markets, which had been hailed, right, like cryptocurrency markets, as this free entry nirvana where fees can be kind of competed down for financial players, what you actually have seen is exactly what a financial economist would have told you, right? Economies of scale and scope loom large, and in those markets, actually, without any regulation, without any restrictions to market entry, we have seen massive concentration of the biggest players, of the biggest swap exchanges, the biggest staking platforms, exactly because of these economies of scale and scope. And so we now have a market that is very concentrated, right? But then in those markets, if we cannot ensure that actually enough players survive, then we might actually be at a place where a few very large players have true market power and extract a lot of rents.
Just very, very briefly, I think my colleagues have covered things quite well. One of the interesting things that could come up in on one aspect of the asset management side is that we think of these models right now as like, you got to invest an enormous amount to make progress. But we just saw DeepSeek being offered today, I think through an MIT license, that is open source, quite inexpensive, and so a lot of different players could have access to it. And I think that's going to be something very interesting to see whether the open source nature of some of these developments, and here you have a Chinese firm that didn't have access to the latest chips, the latest technology, but seems to have provided a product that seems to be quite competitive with ChatGPT 01, is now readily available. People could tweak the model very easily. What's interesting is that one of the things that they had to do, precisely because they didn't have the chips, is they had to be much more efficient. Because they didn't have the chips, so they said, well, how can we teach these models? How can we do inference in a much more efficient way? And so, well, I think we'll get to this later in thinking about some of the consequences of some of these regulatory barriers. But I think there's a potential offset. Now, I think what you said in thinking about it, at the individual level, for sure, you've got you've got to make sure you have something that is that there's enough assets there to make it pay. But also, if you do have this kind of decentralization and relatively small models that can be tweaked, you might be able to do something that is a bit more tailored for people with fewer assets at relatively low cost. So I think there are certainly liquidity, no matter whether you have a lot of technology or very little technology. Back in the 1900s when these markets were just developing in the U.S., liquidity was really the key. That's still going to be the key. But I think, at least in some aspects of this, and particularly maybe on the financial inclusion aspects, if we have it more decentralized, you may be able to get a little bit more tailoring that'll help to reduce costs and have things that are more tailored for people with lower incomes or lower assets.
I agree, and that's already happening, actually, right? I mean, we see that many different bespoke products are being offered to, more sophisticated, less sophisticated people, for sure.
So let's discuss firms a little bit before we come back to the consumer, maybe. So there was the second question I had, which is, now we have those very big asset managers that own a ton of shares of every firms. So is it good? Is it bad for shareholder democracy? Does it improve or destroy, reduce competition? Is it, what is your take on this? Do you have any take? Or is it taking you completely off guard?
In the same order? Or
same order, let's say same order.
We reverse, you go first, Heine?
Oh, okay, reverse it. Okay.
Whatever.
Well, I don't think this is just, I don't think it's directly related to AI. I mean, obviously this has been going on for a while for the forces that Antoinette and Thomas have been talking about, because there are very strong scale economies in these things. And so it's interesting to think about, well, so you get more and more of cross-ownership. And so is that a way to overcome externalities? Because you then have someone who's looking at the whole rather than just looking individually? Or is it that, well, you have someone who's looking at the whole industry and getting it to work together? And so you make sure that you don't have a lot of competition because you want to maximize your profits. At least so far, I don't think we've seen the latter. And I don't think we've seen that much of the former either, because I don't think the levels have gotten high enough that you really are someone who's now, you know, the head of BlackRock or head of Vanguard saying, okay, I'm looking at the economy as a whole, and I'm going to vote these shareholder proposals for the overall good of the, you know, taking the externalities into account. I think we could get there, but I don't think we're there. I haven't seen any evidence of the collusion across the, or by cross ownership by those large asset managers, but that's an empirical question. Maybe that'll change when we get more experience.
Yeah, so from the research and the empirical research so far, we haven't seen that there's active collusion between asset managers to become the, you know, I always think of it, then they're basically like the central planner of the economy, right? Sure. If they want to take into consideration all the externalities, it's not just that they need to take into consideration the externalities within one industry, but if you make one industry collusive, you make it expensive for the supplier industries that you're also owning, right? If you are Vanguard or BlackRock. Yes. And so then you literally have to be, you know, the central planner. And that's definitely not happening. So in fact, what the research, and you know, there's been lots of research going back and forth on this, but what the research suggests is what has happened in the US is just that the economy has become much more concentrated. And because every industry is becoming very concentrated, if you have to hold, as a big asset manager, a diversified portfolio, say, of the airline industry, of the banking industry, right? In airlines, you have 9 to choose from what to do, right? You will hold, by definition, cross, you know, kind of cross ownership. But we haven't seen the collusive part. Now, I want to say one thing, though. It is true, I feel, that those very large asset managers are starting to have a lot of, at least in the agenda setting, a lot of sway, right? Like if you remember when BlackRock started saying that, you know, we need more, you know, kind of ESG in how we invest in funds, or, you know, kind of basically diversity and inclusion, right? Basically topic setting in the market is then, or agenda setting is something that at least, you know, in principle they can do. And we might want to be careful that, you know, they don't have too outsized influence in, you know, how different investors in the market start thinking about those markets and product design and things like that.
No, I fully agree. I think that in theory you could have worried. In practice, I don't think it's very worrisome today. It does make the case for even more careful antitrust policy for the rest of the economy. Because you have to, in any case, any collusion behavior we could have from the finance side would have to build on existing market power at the firm level, otherwise it would not even happen. So it's still, in a sense, like second order compared to good antitrust or good competition enforcement in the product market. The one thing I would say, though, is I think the most likely cost of having high concentration is more like the thing we don't see. That is like the fact that if these guys are too dominant, then there might be some ventures or some funding that doesn't get started because it doesn't attract their attention. So it's not like, I don't think we're going to see them actively doing something wrong, or not any more than people before. It's more like the potential cost is more like an opportunity cost of something doesn't get done.
Okay, so let's continue the topic of firms. So the role of the financial sector is to allocate money to projects and to sort of the most promising projects. And so there are like various companies that need money, and you know you want to direct the savings of investors towards the one that have the most growth opportunities. And so there's a sense in which like modern technology should help with this, in the sense that they should be good at, you know, and there's more data and there's better models to try to predict which are the most promising companies and projects. And so do we see this? Do we see the financial sector sort of adopting those technologies to improve the allocation of capital, which is supposed to be, you know, sort of what the financial sector does? Is it, do we have examples? I think.
Now I have to, now we go in turns. But let me say, so from the perspective maybe where I personally have studied this the most in terms of entrepreneurship and startups, I would say it's definitely happening. So what you can see, for example, is that small business funding has become very data heavy and data driven, and there's now much more cash flow based funding for small businesses than ever before, right? Like if you think about what Stripe is doing or Square in the US, or and now also Amazon, but actually that Alibaba and Alipay was doing in China before, right? It's really actually has, in particular in China, where the lending market was even more underdeveloped before Alipay came in, right? This was transformational for small businesses, that you can, basically get funding from the Alipay platform based on the orders that they see come through, right? Rather than, just having to take a loan when you don't have a credit score and so on.
So why couldn't bank do that?
So I would say two things. One, bank, say in China, from everything I've read, in China in particular, part is that the banking sector was sleepy, maybe poorly regulated, because it's also state-owned banks, and didn't have the incentive to even invest in this. So there's definitely, and this is what Thomas was saying before, right? Like when we often regulate the banking system to be safe, but when we make it safe, we also take some incentives away for them to take risks, right? The other thing, however, that also, and this is where the modern data comes in, the banks don't have the cash flow data, because the beauty, right, so they either don't have them, let's say if you think of Alibaba or of Amazon, right, they see the sales that a given business does at the moment when it's executed. And so at the moment when it's executed, you can see whether the performance of a given firm is changing just in time, right? Or it's becoming worse, it's becoming better. So you want to tighten the credit limit or expand it and so on, right? And the banks often don't have it. And again, the regulation often made it so that the banks, even when they had that data, were not allowed to use that data. And kind of maybe I will say something a bit controversial, but I actually feel that we created in the US an environment where the tech companies were allowed to use data in ways that the banks were not allowed. And so we put the banks at a disadvantage. And don't get me wrong, I'm not gonna, kind of cry about how bad the banks have it, right? But it is true that we put them at a disadvantage vis-a-vis the tech companies, where we somehow pretended that it doesn't matter how they use our data. And I think that is not a good situation to be in. Now, I feel, yes, we are now grappling with it, and we are trying to think about how to do this better, even though I think we haven't solved that problem.
Yeah, I think you're exactly right. This data issue is so important. Traditionally, the banks did have some data, so at least they would have, usually when you took a loan out, you would have to have a compensating balance. You'd keep your checking account there, so the bank could sort of monitor what was going on in a small firm. But exactly as you're describing, there's much more granular data that are available through Alipay, through Stripe, through others. So you're getting transaction by transaction monitoring what's happening at the firm. That's extraordinarily valuable to a lender to know whether whether they should be increasing credit, should they be increasing the interest rate, et cetera, et cetera. And the regulation has made it very difficult. Well, sometimes it has made it difficult formally, and sometimes it's just the way things have evolved at these institutions that it's now very difficult to make change occur. Even if there's not a formal legal barrier, initially it was that the banks had a lot of information, the startups had no information, but the startups had the technology and the banks didn't have the technology. And now there's been such innovation that it's really driven to get the data. And so now you can give a private equity lender, in principle, your access to your Stripe transactions, and they can monitor this. They can see this easily, and it's extraordinarily helpful for a firm, because these new firms are not very credible. They don't have long histories. People don't know. There's a lot of volatility, and so being able to see that is valuable. And then in particular, seeing that not just for one particular firm, but for seeing it for a portfolio of firms. So then you get to understand what volatility looks like in these startups. And so I think we don't have the right balance in the system of incentives and disincentives for that. And I think it doesn't make sense to formally take banks out. And banks have not been very good at financing of startups. It has been much more, these alternatives like venture capital, private equity. And part of it is this data thing. Part of it is just generally the very high expenses that banks have in making sure that they're safe, which of course we need to make sure that they're safe, but then they're not very competitive. Because exactly as you were describing before with relatively low-income people, it's harder to see it be worthwhile to do. It's the same with a small firm. So the big banks, they finance the big institutions. They don't finance the small ones. And that's actually one of the benefits of having this very odd system that we have in the US, of having a lot of smaller banks, because they're willing and able to deal with the smaller customers.
And of course, the US, I would say the US has a fantastic and deep venture capital market that, funds the really high-tech and transformational companies.
So I fully agree. I think it's also useful when you think about capital allocation to distinguish primary markets from secondary markets. So we've been talking about primary markets where you actually give money to an entrepreneur. And there, essentially technology works. So like, the banks, because of their bad technology, bad use of technology, and lack of competition, never had an incentive to really get this product out so efficiently. And then when the startups starting to have the technological advantage, they could do it, forcing the bank to also innovate, and I think that's this virtuous circle. But the key thing to realize is the goal is pretty clear. You want to lend to the right person. Okay, so better technology allows you to lend better, and that goal itself is good. Okay, and I think the issue in some of the AI innovation is when it applies to secondary market, where the goal is not so clear anymore. Secondary market is the stock market, okay, where you don't actually give money to firms. You just trade among existing investors. And there, you could expect the same thing, which is this, if we see the price of a company going up or the price of a sector going up, we think, oh, maybe that's a good signal that this is the place where we should invest, allocate our money. And that, I think, has worked much less well than the micro primary funding market. And I think part of the reason is that the goal is a bit messed up. The goal, if you're trading, is not to produce new information, is to learn the existing information before everybody else. Okay, so there's a big premium to being right. But it doesn't matter if by being right you create new information, and it doesn't even matter if you're right by 1 second or 1 millisecond. Okay, so a game in which you give the reward to somebody who just happens to be right half a second earlier, clearly, in equilibrium is not going to improve the allocation of capital. But that's the game that's played in many secondary markets. So that's why I think in this, you try to come up with measures of the efficiency of the price system in financial markets, you don't see much improvement over time. It doesn't look any better than the 1950s, okay, in that respect. And I think it's not that these guys are not smart. Oh. It's not that the algorithms are not working. It's just that the thing they are trying to forecast is not the thing that the society as a whole would like them to work on the most.
Yeah, if anything, right, they're investing in the technology to be at, nanosecond faster and better, rather than to create new information. Yeah.
So in terms of the predictive ability of new technologies, we can continue. There are many things we can discuss. For instance, let's take the perspective now of customers, and let's discuss, let's say, insurance rather than finance. But that's a part of finance. And so the idea is that imagine an insurance company can predict exactly that you're going to die of pancreatic cancer, in 5 years from now. I'm hoping that you will not, and I'm hoping it never. That technology will never be available. But let's make it's a thought experiment. Then the insurance company would not want to insure you against that risk because they would have to pay, a tremendous amount of money for your care. So it's a situation where being able to better predict, outcomes and better understand the type of person you're actually insuring or actually lending to, that would work also for finance, can hurt the possibilities of insurance among people, and so is it something that we see evidence of in the literature? Is it something that we should really be worried about, or is it just theoretical speculation? Is there any research on that?
So it's called the Hirschleifer effect. So
there has been models. Models have been written.
So it's like if you have an insurance market providing, typically we buy insurance before we know whether there's a fire or not. Okay, so if you know there's going to be a fire, you can't buy insurance. So the insurance is based on the idea that we first write the contract before the risk is revealed. So in this type of market, it's clear that bringing new information can things worse or better. It can go in any direction. So the theory is just telling you that it could go either way. You have to be careful. I think there is a bit more on the. Usually there is a way to make it better, but it has to come with some type of regulation. So I think the more robust prediction is if you want to get something positive out of it, it's unlikely it will happen without changing the market setup of the regulation. I think that's the...
What do you have in mind? What type of regulation would make it work?
Well, so for instance, if you, like say you take David's example, so you're better at predicting a particular disease. Now, if you don't change the system at all, imagine we would buy insurance at a point in time and without knowing anything. Okay, that works fine. And then now it turns out that before we can buy the insurance, we actually know who's going to be sick. So that kills that market completely. Now, if the thing is, you can also have something intermediate where you learn that you're in a higher risk group, risk group, and that actually is useful information. There is still pooling within that group. And if you want something that is good for everybody, what we call like a Pareto improvement in economics, you actually need to have some other mechanism to improve risk sharing even after the information is revealed. So that's kind of the extent to which. Now, whether in practice it's important, I don't know. I'm sure that you have a better sense of that than me.
But what would the mechanism be? So as you're getting more and more data, so there's less and less pooling, and so as you said, in principle, the insurance market kind of breaks down if you can have perfect predictability for everyone of exactly what all their diseases will be. Now, maybe we're at least a few years away from that, but if we're getting towards that, that is saying that the tradition of pooling goes away. But I'm not quite sure what other risk-sharing mechanism you would have. Oh, so or you're just saying like not to use the information?
No, you use the information, but you have to put restriction on private contracts. So you cannot let the private sector offer like a free menu of contract. You say, for instance, everybody has to offer that contract is one option. There are many, many ways to do it, but one simple example would be you're free to offer anything but you have to offer option 0 to everybody, for instance. That typically doesn't get you first base, but at least it's like a start, and then you can do something a bit smarter. The general point is if you bring in no information, there is possibility for a Pareto improvement, but it will not happen under unrestricted private contract. That's kind of this fancy way to say it.
I agree. And then there's the additional dimension, of course, is whether anything of the, how this risk plays out is under your control. Because then you might also want to think about whether you want to leave incentives for people to actually avoid, say, getting sick or not, right? I mean, if we think, some people have genetic predisposition to have diabetes, but if they don't exercise and don't eat well, they make it even worse, right? So we want to insure them to some extent, but we still want probably leave some incentives that they actually, kind of take some individual initiative as well, right? And I think that will be some of the important balancing in these markets.
Well, that's the other thing that's super important is like, say because we always think in terms of like the pure insurance case, but there's plenty of cases in between. If you know you're at high risk, there's more things you can do today to limit that risk. Knowing that becomes important, and then that improves your risk.
Of course, but there the price mechanism plays also an important role, right? Like if you fully insure people, then the price mechanism.
Take a down view of the world where you have directed change. Knowing your risk in advance makes you a customer for a drug that otherwise would not. So that increases the pool of people who are willing to buy that drug ex ante. That make it valuable for firms to actually do it. So like once you go into the real world, we are not in this pure one-shot insurance game. That's what I'm saying.
No, absolutely right. And that has been actually what you just said. In venture capital has been really transformational because we now have so much better models of understanding what's the latent pool of certain diseases in the population that it actually has helped the direction of drug development, right? When before, when this data was not available, these decisions were much more blind, right, and ex post. So that's definitely true.
I mean, there's an interesting possibility which I think it might be that we quickly get to a world where there is not that much adverse selection anymore. Because the truth is the insurance company will know as much as you. Like
more. I mean, we
or somebody even more.
They'll actually know more.
Yeah, exactly. Like especially people are not that sophisticated. Like the idea that they can game you because they know something about themselves. I think that's going to be maybe less and less true. So
we may realize there's no moral hazard anymore.
More hazard? I don't know.
That's really in Big Brother economy where they look at you before and after and all the time.
But also, getting back to what you were talking about before with Stripe, I mean, you can do the equivalent of AI will make it much easier if you say, if a contract is offered that the company will give you, the insurance company will give you a lower rate if you follow these good behaviors.
Right.
It'll really be easy to monitor those behaviors. Now, there are a lot of problems, there are privacy problems with that, but someone might say, I'm willing to make that trade-off to basically have the insurance company monitor my glucose level and monitor my consumption on a real-time basis, just like monitoring the transactions on a real-time basis, and then give me incentives for acting better. Now, that could actually have a positive impact. Obviously, there are big privacy issues.
Big dystopian, yes.
But it's something. It's something we should at least be
of course,
about the trade-offs.
It's true, but there I actually worry big time because at least what we have seen in credit markets or in credit card markets, so what we have seen in credit card market is that actually, people are not fully rational and they often misunderstand themselves and their own self-control and their own sophistication. Yes. And so what, in credit card markets, at least, I have some research on this, you can see that actually less educated and financially less sophisticated people are typically offered contracts that are more confusing, where even the language of the offer letter is more complex and more confusing, and the terms of the offer are more backloaded, and in a way more temptation is built in, meaning, I give you, say, a 12 months or 6 months grace period of 0 APR, but then I charge you a lot upfront. And people might take it thinking, yes, great, 6 months, right, with no interest, and then I will control myself, pay everything back, and be very good about things. But then, what you see in the data is they are not. And so, and the same could be in the insurance case, where they say, I will work out like crazy tomorrow, and then avoid, kind of having to pay for these insurance costs, and then end up without it. So I think, maybe being a social scientist, I very much hope that we will become better and better at really understanding some of these dimensions of people's behavior and help them make better choices. In fact, even help them see their own future behavioral limitations, right? So that they make the right choices. I'm also an economist. I don't want to constrain everything that people can choose, right? But finding good ways of how to make it clear to people, how their future self will think about these things would be very useful.
No, I think that's super. Very quickly, I think that's super interesting because I think. Eventually what we'll do, we'll basically have these avatars of ourselves. We'll do a whole variety of things. I remember when AI first came up, I was at a dinner and someone said, this person's responsible for 30 million marriages. It's like, who is this person? And so he had worked at a lot of the different dating app companies. And his view was that, now what you do is, you can do a few thousand of shift right or shift left to right swiping, but your avatar, who would know you reasonably well, would go through the entire universe and then bring that down to 1,000 people that you could then focus on. And it's the same sort of thing here. They could, could sort of say, well, you have these kind of biases, so we can play out what you're likely to do in 6 months. You don't want to do that, and so we'll show that to you, so don't do that, and you'll be reminded of this. That's the benefit, that's the positive side. There's there's a lot of risk there, but I think it's.
But I think there's a meta point there which I find always kind of funny. That goes a bit beyond finance, actually. What's the impact
there's no
of
finance
AI?
anymore.
One view.
On the dating market, it's.
No, behavior is super important for finance.
Behavior is important in finance.
One view of AI with respect to economics, finance is particularly true, but it's like we're going to get closer to Homo economicus. Because in our standard model, what keeps you away from fully rational decision making, what we call Homo economicus, is like limits on information processing. But I think that I would venture that's not going to happen. What's going to happen is precisely that behavioral economy is going to be more important in the age of AI rather than less, precisely for this reason. And it's not totally, I mean, I'm saying that's not maybe what we would have thought naively 5 years ago. Which I find
so do I want Homo economicus to make my decision in my stead? I don't know.
But, no, but you see what we're already seeing in the market is actually, it's because it's a race between the demand and the supply side. And the supply side is typically, meaning, kind of the ones offering the products and the contracts, are also not stupid. And so they will actually optimize against your little Homo economicus model here to offer you choices that are sometimes very difficult to navigate, right? And then it's really a bit like an arms race.
Okay, so we don't have that much time to discuss the fourth topic that I wanted us to discuss, which is, so maybe Randy, you can take it away, is the topic of new technologies and financial stability. I mean, we believe it's important, financial stability, for various reasons that we know. So maybe there's, I mean, I let you just, throw around a few ideas about that before we conclude.
Sure. So no, it touches on a lot of the kinds of ideas that we've talked about before. So I think one of the concerns that has gone back to algorithmic trading has been herding. So everybody uses the same algorithm, everyone's using the same data, and so you get this incredibly rapid market movements. Now, if that's just making the market super efficient, that's perfectly fine. If there are some issues related to that it overwhelms the market, there are the infrastructure can't deal with it, you can get market breakdowns. Also, you can have mistakes, whether it's in an algorithm or different, so things can move quite far. What's also interesting to see is, we've kind of seen versions of this in looking at earnings reports, looking at Fed statements, that kind of thing. And so what we've seen over the last few years is as more and more of the algorithms do the immediate trading, because they can do it within the split second. Humans actually have to read through the statement. The Fed statement is not that long, but it still takes a little bit of time. These things move in, and you do see some initial volatility that moves up. It seems to be a bit higher in the short run. I don't think that's sort of fundamentally undermined financial stability. But I think ultimately it's going to be, do we see all this herding, or do we see more kind of the decentralized stuff? So for hedge funds and others, it's the so-called alpha. It's what's differentiated. So you're not going to just use the standard model with the standard data set that everybody else is using. I mean, you could do that, but then that's no different than just saying, okay, we're going to do the S&P 500 or just do the average. So you're going to have a lot of incentive for people to do these variations, to do slightly different data, do slightly different weightings, different parameterizations, and so it'll be very interesting to see how that develops. So I think that the issue is not. So I don't think the main worry should be about the herding behavior, beyond the standard stuff that we always have about value of market liquidity, and that tends to give us one market. But I think we're going to see a lot of differentiation, and I think it'll be interesting. I don't think that in and of itself will generate a lot of volatility, but we have to see how these models develop. But I think it's going to be much more decentralized rather than everything is just going to be one or two models, one or two data sets that everyone uses. I think just like this DeepSeek that has become available now just shows it can be much less expensive to do this, and the cost curve is coming down. So you're not going to even have to rely on DeepSeek. I think a lot of these hedge funds will be able to do this on their own. And then actually, DeepSeek has come out of an asset manager of a hedge fund called High Flyer in China.
Okay. Okay. No, thank you very much. Okay, so that's very clear. There are other topics, I guess, we could discuss on financial stability. So please feel free to to ask them in the Q&A. So we're moving now to the Q&A part of this panel. Daron, you have a question, which means you need a mic.
Barely.
You wouldn't be allowed to ask a question without a mic.
Thank you. Thanks very much for that. Was wonderful. I have, there's one other topic, so it's like a question what David said, at the intersection of finance, competition, and technology, about whether the current financial structure with a lot of cash in the hands of tech companies and venture capital is actually sort of creating a pathway to more competition or more concentration. For example, venture capital and other things enabling first mover to collect a lot of data and become dominant? Or is that like a passing phase and this is actually a pro-competition financial structure? I would love to know that, because given the AI concentration issues that is in everybody's mind.
I mean, so I would say from what I've seen in entrepreneurship finance, if you look at what has happened in the US over the last 20 years, it's really quite a remarkable development. So what used to happen, right, is you had a set of venture capital firms that were making large investment and large commitments to a few startup companies. And that's why due diligence in the past used to take 6 months, sometimes even a year, and then they would have an A round that was relatively significant and keep on funding and so on. That model has completely changed over the last decade, or even decade and a half. What now is done, some people call it spray and pray, but what happens is basically that you have these seed funds that are investing about $1 million or $2 million in lots of different startups, often even replicative startups, and let them run for about a year or maybe a year and a half. And at that point, right, when the entrepreneur has already shown some green shoots, as people like to say, right, I mean, has done some development, that's when they start, quote unquote, culling, the firms that will survive. Now, you can say, right, many people say, and I from the data I've seen and also our students at Sloan and Stanford, other places, right, it means more democratization at the bottom level because more firms actually get started, right? And but it has the downside effect that nobody is doing 6 months of due diligence anymore. They do half a week often, right? Because $1 million is cheap, right? I mean, money is cheap. Human capital and time is expensive. So basically, that means, however, who is now bearing the cost? The cost is actually borne by the entrepreneur's lifetime, because it's several entrepreneurs, right, working on the same or very competing startups. They are competing with each other. They are, in a way, bearing the risk of being terminated after a year and a half without much to show for themselves. And so the risk is pushed onto the entrepreneurs. And so why is this? On the one hand, it's democratizing because there's more startup. But if you think about who in society are the kind of people who can bear that risk, it's actually people who have enough insurance and maybe wealth from either their network, their parents, their what have you, right, to fall back on to bear this kind of lifetime risk. And so, to me, that's one thing that we need to watch, how this is developing. Let me say one final this and I will shut up. The thing that I'm more worried about actually is what then happens, what has happened in the US, unfortunately, even though there is so much, in a way, really abundant access to finance at the bottom level, is that we have seen also that the fraction of firms that, even successful firms, that exit via an IPO versus a sale has completely flipped. So 20 years ago when I started, as David was saying, teaching at MIT, I used to make this joke to my American students that the great thing about the US is that startups can exit into the IPO market, grow by themselves, find their own way right to success. And why in Germany, you can hear, right, I'm from Germany, why this didn't happen is because in Germany, the exit options were Siemens, Siemens, and Siemens, right? And that's why we didn't have much of a startup market. But unfortunately, it's starting to happen that in the US, certain industries, even though the industry itself might not completely be monopolized, the exit options, if you don't go to an IPO, right, are very limited for these startups. And on top of it, you have now these behemoths that tell you, if you don't sell to me, I'm going to kill you, right? That's very expensive. So I think it's the product market concentration that now is starting to have an effect on entrepreneurship in the US.
Yeah, I mean, so the big firms in the US, they have surprisingly a lot of financial assets on their balance sheet. It's not just in tech, actually. Many of them do act in part as investors. Exactly. And it's obvious it can be a mixed bag. It is like in the pharma industry, for instance, like you're talking about changes over like 20, 30 years. The decision to do the research in-house versus to let small firms do the research and then buy and actually commercialize, that has changed quite a lot. It's not clear, it's not working well in that market. So I think the key is more maintaining a baseline rate of non-acquisition exit, like IPOs. If that drops too low, I think it has to be something is wrong. We don't know how high it could be, but we know that it has to be non-zero. I think that's the danger.
Simon.
So we've been talking today in the previous panels, and again this panel, sort of on the assumption that the new technology, best technology, falls easily into the hands of big firms who use it to do clever things. But why can't we imagine a world in which someone, like one of you or someone sitting behind me, comes up with an AI-type advice machinery which is very suitable for consumers to sort out their lives? So, for example, for which credit card offer makes sense to me? At whatever income level, or why do I have any money in the bank which pays me 0 interest? I could put it in a money market fund that pays 4.27%. Yeah. Something like that. Could it happen? What are the barriers? Why aren't we seeing it already? And wouldn't that be much more profoundly democratizing and sort of pro allocation of capital and better outcomes for consumers in many ways?
I would say, go ahead. You want me to talk? It is happening. So at least let's say in the consumer finance industry that I know very well, a lot of, say, robo-advice, bespoke investment models were initially developed in startups. And in fact, because the startups in the US felt that they have less regulatory burden, right? As we were talking before, they were much more nimble and they were willing to take certain risks that a Vanguard or Fidelity or BlackRock doesn't want to take. And they developed, say, Betterment, and there were, Future Advisor who Goldman bought, and, but then what happened is basically once the model became viable, you saw actually these firms wanting to sell to the Goldmans and the BlackRocks and so on, because ultimately, the consumer finance model is a model of trust and ease of channel access. And given that these big firms already have so many customers, cross-selling becomes so much easier for them than a small guy who nobody knows about, right, having to go out and acquire all these customers. And so this is exactly, some of the network externalities and the economies of scope that we've been talking about before. So that, at least in consumer finance, has definitely happened. Yeah. That the ideas come, right, but then are gobbled up by the large players.
Yeah, I think it's likely to be more like the pharma business, and for the same reason, which is the thing that's really expensive is, sometimes capital. It depends on whether are you providing a savings product. If you're providing a savings product, then people bring you money. So that's not the issue. The issue is they need to trust you. So the thing that's expensive to acquire is reputation. If it's a lending product, like a credit card or whatever, it's the other way around, which is you need access to funding to do it. That's also expensive. That becomes like the expensive part. The idea itself is not. So I think it makes sense to have a bit like in pharma again, like the idea itself might generate in a small startup. The actual implementation could be done at large scale in an existing player. And I don't necessarily think that's a bad way of doing it. And there's also one way you can sort of finally use some of the regulation a little bit to your advantage, which is like that, because financial regulations are heavy, having like a sandbox, like the Brits coined that name, the Bank of England did that, the sandbox approach, where you have a sandbox where the startups can play and the rules are a bit not as stringent as for the big guys. That actually works relatively well. So it's not obvious to me compared. I think the situation today is quite a bit better than it was 10 or 15 years ago in many markets where they are more competitive, there are more innovation. In fact, it's almost the other way, which is like, how come we didn't have Zeller 15 years ago. It's ridiculous. Okay, they could have done that a long time ago. They didn't because they didn't feel the pressure from Venmo. Okay, so I think that's the model.
But just on that, I think what you're getting at is, couldn't you get something that would say, basically like you're asking ChatGPT, what credit card should I choose given my circumstances? What savings account, what should I do? And get sort of a nice comparison across the different types. I think that will become much easier, but it gets back to this trust issue. Do you trust what this bot is telling you? Now, in principle, you could have a third party who's doing that, and so you have the equivalent of, so you've got credit rating agencies, but they could also be rating the appropriateness of certain products for you. That's very difficult. That has been very difficult, but with AI, it should make it much, much cheaper to do something that's bespoke even for people who don't have a lot of resources. Will people ask the right questions? Will there be a market for that? I'm not sure, but it also could be that you have an underwriter's lab equivalent that does something like that, and people want that kind of certification. I mean, you also have something like Morningstar that now rates mutual funds along certain dimensions, but you want something that is dimensions that are relevant for you, not ones that you have to figure out. Well, what does 4 stars by Morningstar mean? It's someone who, or something, the bot that understands you and your circumstances and said, this is a star rating system for you, rather than for something that's more general.
Just a modern version of Consumer Reports.
Yeah.
Which must have been quite revolutionary when it first came out.
Sure, and you do the same, but this is why it's much easier with a toaster. Is that going to burn or not? Is it going to cause a fire? But for, Antoinette's circumstances versus my circumstances, different kind of toaster may be okay. But I think that with AI, if you are comfortable with giving that information to the your avatar or the bot or whatever it is, it could come up with yeah, this is the right toaster for you, rather than just toasters are this class of toasters are safe or unsafe. For you, it might be different.
Yeah, my name is Nadia Vasilyeva. I'm a postdoc scholar, Fulbright scholar in MIT. I'm from Ukraine. And I would like just to come for the topic of our core conference that's about the shaping the future of the work. And the topic also of our today discussion, that's current discussion, that's about the competition. So just based on where everything starts with the digital situation and all kind of technology, we're starting from the digital transformation, and the core drivers for that was the digital disruption. So that's companies who came with the new completely model. So in that case, coming now to the labor market, we see that, from the financial point of view, it's completely different models, the traditional business versus the disruption-based model business. So it's completely a non-competitive, they cannot compete in the real way. So in real world, they have to change their models a lot. But it's quite complicated. In that case, they have to fire a lot of people, and just to be aligned with the competition here. So in that case, based on your experience, how can business leaders or policymakers, based on your experience, can actually influence or ensure the disruptive model contribution to upward mobility for less qualified workers rather than perpetually inequality? So what do you think from that point of view? Thanks.
Randy wants to go first.
Big question.
Yeah. So can I?
That's actually the big complete, it's completely unfavorable when the big companies, like the Siemens, have to compete with the kind of new innovative startup. They just need to fire a lot of people. So what to do with that people? They cannot just re-qualify them because the skill set, even if they change skill set, it's too many people, to be alive. So how to deal with, in that case, with the labor market?
You're making the assumption that, there's no other demand, and kind of in a way the viability of the economy doesn't pick up other workers. So this is indeed a very big question. I would one thing maybe one can say to this is that at least what we have seen is that if you look at companies in the US. Are indeed restructuring in a way that there's less cross insurance between workers of, say, high talent and low talent within firms than there has been in the past. And so it is true that workers, say, in periphery firms or in small businesses are hit by more of the shocks in the economy, and they're more quickly hit by them than workers in large firms. And that's something where, again, right, we were discussing this before, where society has to then maybe decide whether should there be, kind of social networks that help people that are more prone to shocks to weather them better.
I think it's also it's tricky to, so it changes the nature of polarization in the labor market in two obvious ways. The first is just to implement any AI solution, and in finance, it's extremely clear when you talk to any big manager or big bank, it's very expensive. So they are really fighting for the same talent. So there it's true that big firms might have an advantage just because they can actually afford to hire the talent and therefore reap the benefits. Hopefully that's temporary, but in the short term, it's clearly very big. The other one is across firms. If you think about the cross-section of firms that actually use these advanced technologies, there's a lot of heterogeneity. Yeah. You have like clubs like Facebook that have very, very few employees, but you also have Amazon, where the median worker at Amazon is close to the median worker in the US economy. So I think that it's maybe the ones that we have in mind are always like a bit more on the Google, Facebook side, but if you look at the total, there is a lot of Amazon as well. So it's not clear that we're going to have tiny firms with only PhDs. I don't know that's the model for the future.
Okay, so that concludes nicely this interrogation, the whole panel. Thank you very much for a very nice discussion.